Joining me now with more on the outlook is Todd Walsh. He's the CEO at Alpha Cubed Investments. Todd, great to have you on the show this morning. And 101,000 jobs more than economists expected actually added to the economy for the month of December. What should our viewers take away from this report?
Well, thanks for having me on, Kristen. I just want to acknowledge the ongoing devastation of the fires. We're in greater Los Angeles County, so our thoughts and prayers are with those folks. But that jobs number today was quite a scorcher. We've been seeing the 10-year kind of presage a lot of these sort of hawkish data points and continue to move up. And it's going to put pressure on the market. We've got a lot of catalysts for volatility this year, not the least of which is this continual stream of strong economic data that's going to put the Fed on heavy pause and maybe even on rate rising alert.
Explain that connection, Todd. And of course, we should note here too during this live broadcast that we are very much thinking of those in the Los Angeles area in the wake of these wildfires, as you mentioned earlier. Now, as jobs are underway here in terms of trading reaction on the floor of the New York Stock Exchange, why is it that a strong economy could lead to volatility in the stock market?
Isn't that counterintuitive? That actually provides the counterpoint to some later discussions we can have about how this may end up working to the benefit of the markets in the long run. But in the short run, everybody's been anticipating and hoping for more Fed rate cuts. And the economic data, which had been coming in what we were calling marginal and mixed, right? We were getting marginally slowing data, which supports inflation coming down and being under control, but mixed with some positive data coming out, balancing it out and giving the Fed almost the look that they're going to pull off that soft landing. But this week particularly, we've been seeing hot data come out from the initial jobless claims yesterday or the day before, ISM services, JOLTS, and then today's scorching jobs report. It's clear that there's a lot of hot activity in the economy. The Fed has cut rates twice. There's been expectations and hopes that they'd be able to cut more. But this data is really gonna cause them to have to slow down and maybe even consider raising rates. We've been encouraging investors not to run to one side of the boat or the other, right? We work with retail high net worth investors, and it's really difficult to fight the news flow. You get, one economic data point, you get the market moving one way or the other. At the end of the day, good economic data in the long run is going to end up probably being a good thing for the economy. But if we're looking for that adrenaline rush or the sugar high of some more Fed rate cuts, they're not going to be able to do it because this hot data suggests that inflation might perk up a little bit more than people had been expecting.
And what could that mean for the path forward for interest rates, Todd, insofar that potentially we even see a rate hike at some point this year?
That's the temptation to run from one side of the boat to the other. We've seen a lot of rhetoric come out from analysts talking about potential rate hikes. And if this data continues and we start seeing inflation coming in hotter, that's what's going to happen. It's our view here, though, that this is going to be contained. We've got a lot of cross currents in the market right now, right? We come out of 2024 with another 25% gain in the S&P 500 after a 26% gain in 2023. If logic is our co-pilot, it dictates that we're going to see something different this year. So what does that look like? To us, it looks like volatility. We got high valuations. Let's not forget we have a new administration coming in about a week and a day. And then we have earnings season coming out, almost right around the corner, and it's coming into an almost perfectly priced market. And that's a recipe for volatility. If you remember last quarter, Microsoft missed on a couple of metrics, pretty good earnings report, but they got taken out to the woodshed and had their biggest drop in 2 years. We think we're going to see a lot of volatility, but as an investor, if you, again, use logic as your co-pilot and knowledge as power, and you expect volatility, you can put that to work for you as you continue to participate in the macro trends that are going to continue throughout this year and going forward, and use that volatility to improve your portfolio.
Very quickly, Todd, how should investors respond? What are you recommending to clients in the wake of this?
So if we're expecting volatility, there's some major trends happening, the hyperscaling of AI, some of the large tech companies, which have gone up a lot. A lot of investors have been caught flat-footed, and they're under allocated in those sectors. So use the volatility to add to the best names in the market so that you end 2025 in a much better position than you started. And in the meantime, we've seen rates go up. Our technical projections suggest we're going to cap out around 5%. It's a technical position. We'll see how the data comes in. We could see a measured move from that 3.6 and then consolidation and a move up to about 5% on the 10-year. We like owning dividends. It's the value sector has been beaten up in the last couple of weeks as rates have moved up, but we love dividends here. We think it'll smooth out the ride in 2025, and you're not gonna not like having those dividends coming in while the market's bouncing around, which we're already seeing today on the heels of this hot jobs report.
Todd Walsh, CEO and Chief Technical Analyst at Alpha Cubed Investments. Todd, thanks so much.